Very thrilled to say we've never lost any investor capital.
Why do your repeat investors trust you currently?
I have this antiquated notion that if someone's going to give you tens of thousands, if not hundreds of thousands of dollars, I should pick up the phone when you call me. So try to be incredibly transparent. I'm very transparent about the worst deal we've ever had.
Yeah. Let's hear about it.
We eked out legitimately like a 1% IRR.
You guys have returned a much higher IRR than I've seen amongst other GPs. What differentiates you in that area?
Well, see, I always give this disclaimer.
Investors and operators, welcome to the Invest Clearly podcast. I am your host and CEO of Invest Clearly, Pat Zingarella. On today's inaugural episode, I'm talking to Will Matheson of Matheson Capital. We get into how he and his brother built a trust without a big track record, went wrong on their toughest deal, why they've stayed away from floating rate debt, and his take on sponsors pre-funding distributions. It's honest, sharp, and full of real examples. Let's get into it. The views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice. The appearance of a sponsor or investor on this show does not constitute an endorsement or a warning. Invest Clearly is an objective and neutral platform. Always do your own due diligence before making any investment decisions. Will, thank you very much for joining me. Why don't you start by just telling us a little bit about Matheson Capital and how you guys got started, and we'll hop right into it.
No, thanks. I appreciate it, Pat. So Matheson Capital, high level, we're based in Charleston, South Carolina, and we invest in multifamily across the Southeast, North Carolina, South Carolina, Georgia, Alabama. It's where we own right now. Started buying in 2018. We've had, I think, 7, 8 full cycle deals. Very thrilled to say we've never lost any investor capital. So that's the short version.
Yeah, that's good. That's good. And you guys have returned a much higher IRR than I've seen amongst other GPs on Invest Clearly at this stage in your business. I guess what differentiates you in that area?
Well, see, I always give this disclaimer whenever people ask about that, which is, yes, our average LP IRR is 37.5%. That is bolstered by shorter term holds. Like, you know how IRR works, very time sensitive. So when we were getting started, we were very focused on we're going to do short-term heavy value add deals because we bought our first property when we were 25. Shockingly, it's not the tech space. No one's going to give you tens of millions of dollars of equity at that age. So when we were getting started, we were very conscious of we're going to do heavy value add deals and get in and out in a short amount of time. So on those 8 full cycle deals, the average hold period has been pretty short.
Sure.
And that's allowed us to do it. But, going back to that, like we were telling investors, if you want to do a 10-year hold and get a coupon every 3 months, then there's someone who's got a lot more gray hair than I do. You can invest with that person. We're not asking you to commit to us for the next 10 years. We don't have a track record. We're 25, I was in high school during the Great Recession. But we want you to date us and see if you like what we do and see if we're competent. And that's been a big part of our approach on the exited deals. And there's some other stuff that we do that I think really differentiates us, which the biggest of all is we're a fixed rate debt borrower pretty much exclusively. We have one deal with a bridge loan that's floating rate debt, and that's because we bought it in under 40 days.
Yeah, very cool, man. Okay, so you didn't have a track record then. You've got a track record now. Everything about Invest Clearly is based around LP trust, creating transparency. Why do your repeat investors trust you currently, and what should new investors know about how you build trust and why they should trust your process?
So as far as our existing investors and new investors, we try to be as transparent as possible. I say this all the time when I'm doing introductory phone calls, somebody new wants to be an investor. If you're invested in Matheson Capital, you're either going to have my phone number or my brother's phone number. If you ever have questions, like you're not getting passed off to some investor relations line, you're not getting passed off to some investor relations email that no one's going to respond to for 4 weeks or whatever the case may be. If you have a question about your investment, we're going to answer it, because I have this antiquated notion that if someone's going to give you tens of thousands, if not hundreds of thousands of dollars, I should pick up the phone when you call me.
Yeah.
Just call me old-fashioned.
Yeah.
So, we really try to be as transparent as possible. We're not like a monthly reporting group. We used to be, but it's just a huge time drain. But, I'll send out a quarterly report a month later. I'll have an investor call me. Earlier this week, I had an investor ask me questions about a quarterly report. He asked me on Tuesday. I texted him Wednesday morning saying, hey, I saw your email. I'm working on getting you answers, but I'm on the road all day today, so I'm not going to respond. But I saw it, and I will address it. So try to be incredibly transparent. I had a period where I didn't respond to an investor for like 4 days, and I wrote him an apology email. Just like, hey, I'm really sorry, just like on the road again. I'm like, but you'll get these answers. Because I've seen other sponsors, I've worked with other sponsors, and it's just like a black box.
Yeah. Yeah.
You're just shouting into the void anytime you want an answer. So we try to be incredibly transparent. Obviously, the track record matters, but we try to be accessible. We try to be transparent. We also try to really lay out to people when we show them a pro forma or an investment memo, the parts of it where this is the risk, this is what we think the potential problem is, this is where we don't think that we're actually going to do what the investment memo says, which let me elaborate on that because that's a really weird thing to say.
Yeah.
We're more focused now on longer term holds than we were when we started. Part of the reason we did the short term holds back then, 2018, 19, 20, was so we could do longer term holds. But it looks really stupid to show a 1-year hold on a pro forma. It looks dumb. It's like, yeah, I think I'm going to get you a 40 IRR. Like it. So we would tell investors, yeah, here's a 3-year model. We're going to try to sell it in a year and a day, capital gains reasons. And we still do that. We're raising on a deal right now. I've had the conversation multiple times where it's an older asset. It'll cash flow. And I say, look, it'll cash flow. It's a great area. Really like it. The downside is I don't know what it'll sell for in 5 years. I have no idea because it's, a 60s construction property. It should cash flow. If we hit our pro forma, we should be able to do some refinancing just on a DSCR constraint. But I don't know. And we're very upfront about that. So we're accessible, we're transparent, we lay out the risks, we lay out the upsides. I hope that doesn't sound too boilerplate. Oh, here's one more for you. I'm very transparent about the worst deal we've ever had.
Yeah. Let's hear about it.
Worst deal we've ever had. Greenwood Village Townhomes. I don't know how many times I've talked about this property. We ended up getting, for a deal that was bought in December of 2019, which you would think, wow, what a great time to buy a deal.
Yeah.
We eked out it's legitimately like a 1% IRR. I actually think it's below 1. We didn't lose money. Our investors made the most minuscule profit imaginable when we sold it in March of 2022. There were a lot of reasons it had problems. Right before closing, some bad characters moved into the property. We were scheduled to see them in eviction court the day the courts closed because of COVID. So good timing. And the property, it was small. It was only 24 units, really, gated, serene. But as soon as we couldn't evict the bad characters at the property essentially became overrun is a little bit terms, like just drug dealing constantly taking place at the property. All the tenants who actually paid rent left. So Evan and I were pumping money into the property to keep it afloat because we didn't want to go into forbearance, which was all the rage back then. Mm-hmm. So we were the first ones putting money into the property. We had to go through 4 different property managers, some of whom quit because the property was such a problem. And we ended up getting out of the property in March of 2022 by packaging it with another asset we owned in Charlotte. This was in Charlotte, North Carolina. So we packaged the two together, sold them as a portfolio. We bought it for 3.3. We sold it for $4 million, call it. But what ended up happening is we had a yield maintenance prepayment on the loan, so we paid $250,000 yield maintenance. We had pumped a lot of other money into the deal, so at the end of the day, it pretty much made no money. But yeah, we were transparent with investors. We've had investors where that was their first deal and they've come back, which is kind of amazing because we're talking about.
That's what I was going to ask. Yeah, I was going to say, what is when you're having that conversation with new investors on the phone that have never met you for the first time? Is it received well as hey, I appreciate the transparency, or is it oh boy, what's next?
I don't know that I've ever really been chewed out by an investor. I don't know that that's ever happened, but I feel like most people appreciate the transparency, especially if it's around something like, hey, this is a COVID, or this is not really relevant anymore, but like this was a COVID related issue. In my humble opinion, I think where you really run into problems with investors is when you say, here is my business plan, and you just fail at the business plan.
Sure.
Like, I'm going to buy this property and I'm going to do value add renovations and I'm going to hit these rents and this is what's going to happen. And then that doesn't happen. Like, there are horror stories in South Carolina because South Carolina taxes reassess upon the sale. It's not like a 4-year, 8-year cycle. So I've heard stories of like someone buys a property, so the taxes go up. And then they say they're going to do a value add plan and the rents don't go up.
Yeah.
So they just made the property less valuable than when they bought it because now the NOI is down because the taxes jumped and they're pumping money into units that is getting no return. That's how I think you really lose investors. But if it's interest rates, if it's COVID, if it's the sales market just swinging out from under you, there are macro factors that we can't control.
Yeah, and I just think your position bringing that up on calls is where LPs are looking right now, and it's I would say refreshing that you say that you and Evan are readily available. I mean, the biggest thing we hear from investors right now, even those that are losing money, are focused on the communication more than anything. It's like, yeah, sure, we don't know what's like. I'm assuming this is going under, but I just wish someone would call me back. You know what I mean? It's a wild thing out there when people are facing total loss of capital, and like the one thing they're bringing up more to me than anything is like, I can't get a hold of them, no one's telling me what's going on. So it's nice, but like that leads me into my next question. So right now it's you and Evan. You're taking the investor calls, you've got direct communication with your investors, you've got big goals over the next few years at $1 billion under management. How does like LP communication and like retaining the same trust process and transparency process you have now as you guys scale those acquisitions?
Yeah, so I mean that's eventually going to become an issue that the amount of conversations with LPs will exceed the amount of time. At some point, I think we will have to bring on somebody to do investor relations, which kind of takes away from like, hey, there's the direct outlet. But I still maintain like, look, if you're investing in our deals, you're going to have my phone number. I can think of I think it's a Kevin O'Leary clip where he talks about I've got 2 phones. One's the personal phone, one's the business phone, but you just are explaining to people. The business one's for like emergencies. Like a lot of people have the number, but a lot of people still don't call it. So it's like, look, if it's a normal IR question of like, hey, what's going on? I saw this in the report. What does this look like? But, there's always, you can go that route. Again, I'm projecting into the future. I would say, look, you can go the IR route, but if you really need something, like you'll still have instant access. You'll have my email. You'll have all that stuff. Because again, like managing equity is a privilege. You're not entitled to doing it. I do think where a lot of sponsors end up getting into trouble is the faucet just becomes so like you just touch it and the water pours out and you become a little bit entitled to it, and that leads to when you start juicing the fees to 4% acquisition fees and I've seen 4% asset management fees before because like the money's free and you just take it for granted at that point.
Yeah. Building on that, in terms of Matheson, how do you guys make money on your business? So like how are your fees structured?
So our AC fees are typically going to fall between 1% to 2%, depending on the deal. So it'll be a 1% to 2% acquisition fee, a 2% asset management fee, and that's 2% of EGI. It's not 2% on equity. Some of those fees are really, really high. I understand it's a little different if you're in a fund structure, but yeah, we're typically 2% upfront, 2% on asset management, and then we used to have disposition fees. I don't think we really incorporate those into deals any longer. So then it's just back end promotes.
Yeah. Do you guys have any plans to go the fund route, or are you sticking with single assets for now?
Single assets for the foreseeable future. My thing on funds, generally speaking, is like, well, I think there's benefits to LPs. Let me be really direct on that. I think that the fact that if a GP screws up one deal in a fund, they can wipe out their promote. Like they could do 7 good deals, 1 bad deal, and they'll wipe out their promote. That's good for LPs. That's good for LPs. I also think funds allow you. I'm telling you, I'm not going to do a fund. I'm talking about all the perks of it. But I think funds allow you to compete on timeline as opposed to price and like surety of closing. Because I talk to brokers and it's like I lose deals all the time to discretionary funds because it's just a surety of closing. I've got to tell a broker I have to raise all the money. Fund comes up and said I already have it. That's good for LPs. So the GP's portfolio-wide commitment, I think, is good for LPs. The fact that you have the money at hand makes it easier to do. But I don't think I could raise $100 million equity fund. And if you're dealing with like a $30 or a $20 million equity fund, it's like you're to diversify the fund across like 7 assets. Your average check size is below $3 million, and then you're just chasing these smaller deals that we're honestly trying to move away from. Like when we started, we were buying 32-unit deals, 24-unit deals, 15-unit deals. Now we're trying to buy bigger stuff.
Yeah.
Because they're just very demanding on the small end.
Sure. And what do you do to attract new investors now? Like, how do you guys get new investors in the funnel?
I'm embarrassed to say you've seen my LinkedIn posts.
Well, that's
You've
what I was
seen
going to bring up.
Evan's
Yeah. You're active on
Obviously, I go
social.
to Invest Clearly. I have
No,
great
that
results on
wasn't
that
the angle.
website. And
that
people,
wasn't the
people
angle
come
yet.
in through that website.
Yeah, not the angle yet. No, I wonder because you're super. Socially active. You're literally the only person that ever likes any of my tweets. So I appreciate that. But I didn't know if you guys are like one of the ad running companies or if it's like returning
Anytime,
investors
man.
mainly. Yeah, you're my only friend on X. Yeah, I was just curious. But cool.
No, we're not an ad running company. Yeah, we're not an ad running company. I've talked to groups about that, and it's like, yeah, pay us $100,000 to set it up, and then ad spend, and I'm like, for like, if you're charging me that, I want guaranteed results. Like, have you ever heard of? I hate to be rude about this. Have you ever heard of Marcus Evans, the company?
I haven't.
I would love somebody to come out and tell me that they've worked with them as a testimonial to how great they are. But their business model is like, pay us $100,000
Oh boy.
and we will put you in a room with family offices and you can have conversations with them. It's like, I'd rather pay an equity broker.
Yeah.
Like, it's a $100,000 gamble at that point. Maybe they'll work with you. Maybe they won't. Like,
Yeah, I'll look them up. I haven't heard of them. I know the agencies across some of them. You know what I mean, the notable ones. But haven't heard of them. I guess that was kind of leading into my sort of like a lot of the GPs are doing it, right? They're running ads. They're really heavily investing in influencer marketing. This episode of the Invest Clearly podcast is brought to you by Scale IR. If you're raising capital, you know the hardest part isn't just generating leads. It's turning those leads into committed investors. That's where Scale IR comes in. Scale IR transforms your investor engagement process with their proven solutions that optimize lead qualification, accelerate investor conversations, and drive higher conversions. From seamless CRM integration and intelligent workflows to expert investor qualification specialists who handle your initial discovery calls, Scale IR gives your team freedom to focus on closing deals. If you're ready to scale your investor relations and capital raising effectiveness, visit scaleir.com to learn more and book your strategy call today. Scale IR. Engage smarter, convert faster. I know you are active on social, which is great. How do you balance like what's marketing and what's education? Like how do you define that? Okay, I'm actually trying to provide value to potential LPs versus this is just a get in the funnel now type process.
so we're not a group that's like putting out a ton of educational stuff. There's a few articles on our website that are just like explainers on a few things. We send out a monthly newsletter, but like we don't do coaching, we don't do educational seminars or anything like that. And I'm reluctant to really say that the stuff I post on LinkedIn is educational. My LinkedIn theory boils down to there will be one thing a day that annoys me, and that's what I'll post about.
Get after
Um,
it. Yeah.
yeah, like something will bother me, and I'll just be like, "This is dumb. This is my thought on it," which is I mean, it is educational in a way, but we don't have like a systematic educational movement, and I know some groups have gotten a lot out of that, but I am generally pretty skeptical of a lot of coaching slash educational programs
Yeah.
because it just seems like it's a like look, I want people to invest with me. Let me be really clear about that. That's the business, but I feel like a lot of things are dressed up as coaching and education when it's really just a feeder to this is
Yeah.
why my deal is going to be good.
Yeah. I agree. And a lot of
And
that
I mean,
is coming out.
yeah. Yeah, I mean, like if you're I know some people who do coaching, so, I'm painting with a broad brush here, but if you're the greatest sponsor in the world, why are you spending all your time coaching? I mean, well, actually, I could give you a very good reason why. It's the income.
Yeah.
I go on this rant quite frequently. Nobody wants you to make money as a sponsor, which seems like a contradiction, but at least on the front end, um, because it's like, well, you have to invest, call it 10%, and then you get the fee. And some groups are like, well, 10% net of fee, so if you're putting in your acquisition fee into the deal because it's 10% plus whatever your acquisition fee is, then, money's fungible, but the whole point is you're not making money when you buy it.
Yeah.
And the asset management fee is, not huge, and you're going to have an asset manager. So you really only make money when you sell a deal, which makes sense in some respects. It's just, I think people own or manage, and I think people coach because of the income. We don't do either one of those.
Yeah.
We had a lot of successes. We're in a really good situation financially. But we still try to stagger deals so that we believe we're going to have a promote hit every year or something like that. We still do that.
Yeah. Yeah. That's good stuff. All right, now to the question we were talking about beforehand. What part of passive investing do you think needs to die?
Part of passive investing that I really think needs to die are funding your distributions up front through investor equity. It's not even robbing Peter to pay Paul. It's just robbing Paul to pay Paul. It's one, I mean, it's not a real return. It's a synthetic return. You're just collecting someone's money to then give it back to them because your asset is not cash flowing. And the other aspect of it, which I think a lot of investors miss, is that you're just making it harder to end up profiting at the end of the day when you do that, because now you're getting a preferred return on top of the money that's being returned to you for your original preferred return. So you'll see a deal where someone might be buying it for, say, 100 a unit, and then between their reserves, which are really used to pay the investor, and the closing costs and the rate buy downs and the capex and the fees, there'll be a $150,000 basis on a $100,000 purchase. And it's like, well, that's great, but now the value of the asset has to go up by 50% just for you to break even. Like, to get your equity out, you have to increase the value of the asset by over 50%, which, maybe that works, but I feel like people overlook that. They see the basis of the asset, but they don't see the total capitalized basis. And I think pre-funding your returns is a big part of why that happens.
Yeah. There was a good stretch where it was literally a theme on LinkedIn or X where people were just shredding those decks. Like they were coming in troves and people were just slaughtering them online. It was just like an interesting thing to see being a trend. You know what I mean?
Yeah, I know. I mean, it kind of should be. I mean, like, I if you're doing a rate buy down on a Fannie or a Freddie loan, like that's kind of still like there's a limit to what you can do. But if you're taking out a bridge loan and buying it down to 5%, I mean, the fees on that can be astronomical. But it's like, oh yeah, look, I have this 5% that I paid, $5 million for. up front, and now I can quote unquote show cash flow. I mean, that's another way of essentially pre-funding your deals. I mean, there's a limit to what you can do with Fannie and Freddie, so I'll kind of give that a pass. But when you're doing it with like the bridge lenders and buying it down to 5% cap rates, like that's essentially pre-funding your distributions by artificially compressing your debt.
Yeah. Yeah. All right. Well. I know we're coming towards the end here, so I'd love to know: are you guys raising right now? Is there anything additional you guys want to talk about in terms of Matheson or your deals or anything that we haven't gotten to?
I mean, we are raising, but we're bringing that to a close. I mean, we try to stay active, but what I really, and you didn't tell me to do this. I'm being pretty honest with you. So just like a peek behind the curtain is, so we met spring 24, or was it
Yeah. I mean,
23? We met at best ever in 24.
Mm-hmm.
Yeah. So we met at best ever in 24, and I was like, wow, this is a great platform. Every time we have a closing, we're like, here, investors, look over here. Go to
Yeah.
Invest Clearly. Go to Invest Clearly. So, as your inaugural podcast, I think this is your inaugural.
Yeah.
Can you talk about the platform? Which again, you didn't ask me to do, but I love the platform. I think it's great. I think there are a lot of bad GPs out there. I think some GPs over broadly kind of get a bad rap. But I think there are bad GPs, and I think Invest Clearly is a great way to highlight good ones and kind of expose bad ones in a verified way. So, please talk about that.
Yeah. And I might turn it back on you a little bit because I appreciate that. And you were one of our really early adopters. And I know that platforms at the early stage are not easy to have confidence in. But I would actually love to learn, like, what led you to actually start leveraging Invest Clearly. I mean, obviously, like there's the surface level items, but if you even take the business out of it, like why did you kind of take the jump to ask your investors to start putting things on there?
So it really is two things. Number one, I'm incredibly full of myself. So I couldn't imagine anybody giving us a bad review. I mean, at the time I started, we had like a 40% average LP IRR, and as I posted about on LinkedIn, we had a great deal that we bought in October 23. We sold in December 24. So it's a great deal. It's like 40% return to the investor, but because it was in 14 months and not 12, it dropped our IRR to 37.5%. It's just brutally heartbreaking stuff. I posted the tombstone of our 40% IRR out there, but. The big thing was I was really confident in us. I was really confident in us, so I thought we would get really great reviews. And on the other end, I knew there were going to be other investors or other sponsors who felt the same way, and other investors out there. And so people who are reviewing other sponsors would see what we're doing, and they'd be like, "Oh, I'm curious. Let me see who Matheson Capital is," and et cetera, et cetera. And we've had people come to us who said, look, I heard about you on Invest Clearly. And the thing about that is I know some people kind of take this approach of, some people kind of take this approach of like, oh, well, I don't want my investors to like be looking up other sponsors. Well, you don't own an investor. Like you don't. That doesn't mean you're going to go around and like, introduce every sponsor to, hey, here's John, he's invested with me 7 times. Like, you're not going to do anything like that. But they're all adults. They're going to look for their own deals. If they want to look for new sponsors, they're going to look for new sponsors because they know what your job description is. Mm-hmm. Real estate private equity, real estate syndicator, go on LinkedIn, just Google it. So we felt like, look, if our investors are going to look for other sponsors, great, they'll be diversified, they'll be diversified. They'll work with other people, et cetera. They'll see why we're the best. So we weren't worried about our investors seeing other sponsors. But we also saw the upside. And look, if we're active on this site, other investors from other sponsors will see what we do. And they'll like that. And it's just a math game.
Yeah.
Which, again, I think is a huge value on what the website is. Because there's 100 other sponsors. Well, actually, you might know. How many sponsors are on your website?
We're flirting with 1,400 now. A little over 100. A little over 100. A little over 100 in, I don't know, maybe 10 that are actually actively engaged. you know, you guys are one of the most engaged sponsors on there, but yeah, right around 100 actively leveraging it.
Yeah, so there's 100 sponsors that are actively leveraging it, but you've got 1,400 sponsors. So I'm sure there are a bunch of people out there who have invested in. I'm not going to name a sponsor who's fallen on unfortunate times. That just seems mean, even the ones that are publicly known. But the their investors are coming out, and they may see us even if the sponsor's not actively engaged. So if there's 1,400 sponsors in the world and we're doing a good job, that's look, 1,400. There are plenty of groups bigger than us. They'll see us.
Yeah.
Personally, I stand more to gain by being active on your site than I stand to lose.
Yeah.
And I'm not losing anything because I don't own an investor.
Yeah.
Like, they're adults.
What's interesting about that too is like that is a fear of some, right? And we exist whether or not the GP participates anyways, but my partner Joe runs another company called Scale IR, and they put together a data set across like their client base of how many LPs were actually in like across multiple GP databases. And I think it was some odd like 40% of the LPs that enter into a GP's database as like an interested person was actually in at least one or two other GP databases, and it happened within the first 30 days. So I think like the ignorance that your LPs aren't shopping is kind of like a wild concept. You know what I mean? Is like people are shopping across the board, and it's better to represent yourself in the best light possible for when they see it than to just kind of bury your head in the sand and think they're only looking at me and I don't want any part of this. But I appreciate everything you said. And look, I've been kind of conservative on other podcasts that I've gone on, but everything you listed is sort of the reason why we did start this. Is like when I was selling accredited investor lead gen services at one point, and I had talked to a sponsor who their coaching program was killing it, and their real estate was getting beat up. And it was just like a wild thought to me, you know what I mean? And at the same time, there were really great sponsors out there that aren't marketing, are going unheard of, that really didn't have a place to be found. And like, that was our goal. Like, okay, let's work with these companies who have a deep relationships with their LPs that keep returning, that may not be spending tens of thousands of dollars a month in ad spend, and like, let's give them a way to be represented and neutralize the marketing spend of other people who may or may not be good sponsors but just have deep pockets. So I appreciate everything you said, and I really appreciate the support you've shown us, and even something as simple as this. You're the one that told me to start this podcast. So like, it's something we've been thinking about for a while, but your nudge was like, all right, yeah, I'll finally do it.
Well, don't give me too much credit, because as we discussed at the beginning, I part of the reason I encourage you to do the podcast is if a GP is anything like me, they just love to talk into a microphone.
Yeah,
And then,
yeah.
I'll let my investors know, and hopefully no one leaves us a bad review. But if they do, I'm sure we would deserve it.
Yeah.
But
It's good.
but
It's
no,
a good way to think about it.
one of the. Well, so that was just one of the other notes, just in terms of the reason and why you started and all that stuff, which is when you verify that the investors are real.
Mm-hmm.
Like you verify that an investor is real. You don't need the GP to approve of the person. It's like, hey, do you have a K1? Do you have a screenshot from inside your portal or something like that? So it's not, it's not Yelp. There is an anonymity perspective or aspect of it, which some investors like, some investors don't. But there's an anonymity to it, which I think investors can appreciate, especially if it's a bad review. But it's verified. So yeah, instead of it's kind of like, yeah, do the results actually matter? Are the investors happy? If the investors are happy and they're real investors, then they're going to come forward and they're going to talk about it. If they're mad,
Yeah.
they're going to talk about it. So I think it's a great service, and I'm glad you're starting this, and I hope a lot of GPs come on, even the ones that have, obviously the ones that are doing well, I hope they come on, and I hope the GPs that have kind of fallen on a bit of a hard time with floating rate debt. I'll give this as a fixed rate borrower. I don't hold this over people's heads. I have some real sympathy. Like, look, 2020, 2021, I think some pricing got really stupid. But it wasn't until December of 21 when the Fed actually started saying, oh yeah, we're going to start raising rates. Like, it all changed in like October to December. Until then, they just kept saying, we're keeping them low, we're keeping them low, we're keeping them low. Inflation's transitory. And people bet that that was accurate. And that has caused a lot of problems for people. So I do have a lot of sympathy, even though we did, stay immune to that pressure. We never got into the floating rate bridge loans. We always stayed with fixed rate debt. So I'm sympathetic, but I hope a lot of those GPs come on as well, because there was a little bit of groupthink there. Not
Yeah.
so.
Yeah, I hope so too. Well, Will, thank you so much for joining me. Thanks for nudging me to do this, and look forward to keep working with you.
Yeah, thank you, Pat.
Yeah. Thanks for listening to the Invest Clearly podcast. To find verified investor reviews or to claim your GP profile, please visit investclearly.com. If you enjoyed this episode, please remember to like, subscribe, and leave a review, because that's how other people find this show. Till next time, invest clearly.